Morning, ladies and gentlemen, and welcome back to Boutiques on Wednesday. It's always great to have so many of you join us. SA bonds and flexible fixed income funds have served our clients extremely well over the past year plus, and you could even say over the past 10 years. But can the party continue? Today, we will have a wonderful panel discussion looking at the current market dynamics affecting the local and global fixed income environment. And it's my great pleasure to welcome our moderator for the session today, Eugene, Director and Head of Strategy at the Optimum Investment Group, or OIG. Eugene, maybe before we going, just for the audience, and as a matter of interest, I mean, you've been in the industry for a very long time as well. You were Head of Investments at Nuvare, and you were also Portfolio Manager at Morningstar before you joined Optimum Investment Group. So I think you're very familiar with portfolio construction and in a multi-manager world screening fund managers. So you come with a wealth of experience, and I think ideal for this panel discussion this morning. Thank you so much for joining us.
Thank you, Norm Genoot. Looking forward to our chat this morning. Morning, ladies and gentlemen. As Eugene said, I'm Director at Optimum Investment Group. We're a boutique asset manager managing just short of 16 billion rand. We focus mainly on the retail market. I think our distinct advantage is using more of these alternative type of investments in solutions to clients and building bespoke solutions for clients. So we build quite a number of bespoke solutions for families, family trusts, investments and the like. But looking forward to today's discussion. I think there's lots of topical stuff going on around the world and locally. So with that, I'm going to jump straight into it because there's a lot of questions that I'm going to try my best to cover. I just want to check, Eugene, we can take questions from the audience as well.
Eugene, definitely. It's entirely up to you. We normally deal with questions from the audience at the end. But since it's a panel discussion, I mean, it's up to you. If you want to deal with
questions. I'm going to try and monitor it, and I think if something interesting pops up, then we'll definitely try and address it.
Sydney, thanks, welcome. Eugene. And for the audience, the story Q&A bubble, just post your questions there. We'll keep an eye out for that. Thank you so much.
Thank you. Sydney, Phil, Brad, if I can ask each of you just to introduce yourself very, very briefly and your company, and then we'll jump straight back into the panel discussion. You know, I've got some riveting, very difficult questions waiting for you guys, and you will all get a grade at the end of today.
Okay, thanks, Eugene. Yeah, hopefully you'll go easy on us. But yeah, I'm Sidney McKinnon, CIO and Portfolio Manager at Cadiz Asset Management. So been in this game for a long time, hence the grey hairs. And yeah, looking forward to today's discussion. Thanks, Eugene.
Thanks, Sidney. Brandon?
Yeah, good morning, everyone. And of course, morning to my fellow panelists. My name is Brandon Quinn. I'm the CIO of Saffron Wealth. We're a hedge fund company based in Stellenbosch. Our fixed income propositions are our active bond fund, our opportunity income fund, and our dollar global income fund. So all of the opinions and whatnot that we discussed today are expressed inside those three funds.
Thanks, Brandon. Phil?
Thanks. Yeah, I'm Philip Bradford, CIO at PortfolioMetrix Asset Management. I get involved not only in managing fixed income, but across the multi-asset spectrum as well. So we've got a range of funds, everything from an income fund to dynamic income fund, which is our more sort of flagship, as well as our bond fund. But then I think importantly in a panel like this, the discussions on multi-assets are important when looking at local fixed income as well. So I'm looking forward to talking about all of that.
Thanks, Phil. Gents, I want to start with offshore first. I don't want to spend too much time on that because who knows what Trump's going to tweet tomorrow or later today and what will happen there, and mainly focus on the South African landscape. But where we currently standing, Brandon, I'll start with you, SA versus offshore, and specifically the developed markets. The US as an example, we don't know if Jerome Powell will still have a job by the end of today. The Germans like pumping up debt at the speed of white light.
Defense.
How does that compare to our landscape currently?
Well, I think, yeah, thanks, Eugene. I think the question really needs to go to sovereign versus corporate or credit. So if we're comparing the appropriateness of sovereign debt specifically developed market sovereign debt for an SA fund, it's not that easy to justify. The South African yield curve is rewarding our investors remarkably well at this point in time. It's very steep, which means the term structure is rewarding the investors versus less steep in developed markets. On the credit side, however, I would say that the diversity and the expanded universe of the offshore market offers far better opportunities to enhance yields from a credit perspective than domestically in South Africa. The South African credit universe has shrunk. 10 years ago, I think there were double the number of listed entities on the JSE, and we prefer listed issuers. Today, there's half as many, which means there's half as many listed issuers, which is crowding domestic credit into the unlisted private space, which I think we've got to be careful of.
That before we go into too much detail, because I think we need to focus on that as a topic discussion by itself. This is unlisted credit, and we've seen some blow-ups happening there over the last couple of months alone. So I'm just going to pause there for a second. Phil, do you have anything to add, the offshore versus, and specifically developed markets and South Africa?
Well, I think that most importantly, when we're talking fixed income in particular, it is very macro driven. So what happens, it's not like we're independent. It's not like you're sitting somewhere in the world and going, oh, I think South Africa is better than the US. What happens in the US has an enormous impact on what happens in our rates, our yield curve, our ability to cut rates, etc. So you can't divorce the two decisions. I think what's quite important, what Brandon touched on there, was if you're trying to generate the best rand return possible, and you don't want to take currency exposure, then obviously there's some great opportunities in South Africa. But more importantly, over the last number of years, the ability for us to access offshore exposure, hedge it back into rands, and get a decent rand return has expanded significantly and has broadened the opportunity set. So it's not as simple as local versus offshore. It really is about what is the broad opportunity set to us. And I think as fixed income managers, we're looking at all of it as opportunities, even for rand returns.
Okay, thanks, Phil. Sydney, anything to add to that?
Yes, thanks, Eugene. I think Brandon and Phil have hit the nail on the head, but I'd like to think of things from two different angles as well. I think you've got to look at it from two angles. The one is, as fixed income South African investors, what's the advantage of getting involved in your local market versus the offshore market, or what is the benefits, or why would you want to do it? And then, of course, the other side of the coin is, if I'm sitting in London and I have to place money across the globe, how do I actually go about, and what do I want to do? And I think Brandon's made the very relevant point of sovereign risk, and particularly currency risk. And it does appear that even if you're sitting in London or anywhere else on the globe, the currency risk becomes a lot more important. And the currency risk, or the currency volatility, and we've seen it happen with the dollar now over the last little while, becomes such an important play, and it could very well obscure or even wipe out the great or fantastic real yields or great yields that you're getting perhaps in an emerging market. But I definitely think from a South African perspective, the reason why you would want to go offshore, look at broader markets, is because of diversification more than anything else. We've got such great real yields here, and that's really serving our market well. So yeah, at the risk of rabbiting on, I think one has got to look at it from the two angles, but most certainly, if sitting here from the South African perspective, there's definitely a value that you can actually extract from our local bond market, especially in terms of the real yields that you're getting.
Sydney, you mentioned something about emerging markets. Now, Phil, I want to backtrack to you, and like that rand returns. What does the emerging market landscape relative in that rand returns look like to South Africa? And I'm specifically referring to Trump is targeting Brazil nonstop. Russia's not really an investment opportunity at this point in time. I have no idea what's happening in Mexico. Does the country still exist? What does South Africa look like relative to these other emerging markets?
So 2-3 years ago, coming out of the back end of COVID, and we started having that reflation going on, it was a bit more severe than that. South Africa at that same time was seriously struggling because our growth was holding us back. So the LATAM countries, Brazil, Mexico in particular, were doing incredibly well. 2 years ago, the rand was almost the only country really out of the decent EMs weakening against the dollar where those were strengthening. What's happened subsequently, in addition to the Trump problems, Trump for Brazil and Mexico has obviously created big problems for them. But Brazil lost the plot from a fiscal perspective. So while we like to knock the South African government for a number of things, they've actually done a reasonable job compared to a lot of the others in the fiscal space. So Brazil lost the plot a bit. They did the things that we haven't done, and all of a sudden they've fallen down a lot. So South Africa, in many respects, is probably the cleanest dirty shirt out of a lot of the emerging markets. Not necessarily because we've done anything really well, but some of them have made a lot of mistakes, but others have. But the tide has kind of been moving back in our favor. We're a little bit sheltered from a lot of, obviously Mexico and Brazil are getting more hammered by what Trump's doing. And we luckily a little bit distant or a little bit more protected from a lot of those things. So, and the real thing I think that's changed is interest rates are quite high actually in a lot of those other countries in nominal terms. But in real terms, our inflation has been kept under control significantly more than it has in those countries. So the real yields relative to the trajectory that we're on, South Africa is looking a lot more attractive. 2 years ago, it was exactly the other way around.
Brandon, do you have anything to add to that? Especially, I liked Phil's comment, the cleanest dirty shirt, if you were an investor specifically sitting in the UK.
I think that's
South Africa
entirely,
look like the darling.
Yes, I think that's entirely appropriate. We've also been called the Switzerland of Africa. There's another analogy that's been bandied around.
Switzerland of Africa.
Yeah, so yes, I completely concur. I think he's on point with regard to the real rates. It's a real rate story that really will determine the flow of funds between currencies. Our view right now is that the dollar has been particularly overpunished, and there's possibly some space for some dollar appreciation to start coming through, particularly against the euro. But I think emerging markets, the universe has shrunk again quite significantly. African emerging markets like Angola, Zambia, Kenya, Egypt are largely off the table with regard to lending. The default experience there has been too extreme. I think it's scared many investors away for quite some time. And likewise, Brazil, like Phil said, has made strategic errors that could have easily been avoided. So South Africa, by our slowness and lack of activity, has almost distinguished itself as a more stable destination from that perspective.
And no other countries, you specifically mentioned Africa, but is there any other opportunities within Africa aside from South Africa?
Not that we're looking at. I mean, there are some very, very specific countries like Morocco, which has a euro peg, which gives an interesting opportunity.
Yeah, it's really an African type of return
precisely.
profile.
Yeah, precisely. So I wouldn't say we're looking at expanding our African footprint at this point in time. South Africa is giving us enough liquidity, and that's an important consideration, the liquidity of the instruments we trade. South Africa offers remarkably good liquidity, one of the best bond markets in the world from a trading point of view, which I know Sydney and Phil would agree with. So there's not necessarily a lot of reason to be stepping outside of the South African universe. That said, though, in the banking and corporate space, we're utilizing between 30 and 40% of our total funds in offshore assets, both European banks, UK banks, and American banks.
But Brandon, then you hedge out the currency risk.
Quite right. Quite right.
Yeah. No, sorry, Eugene, on that though, just to put numbers on it. So like Brazil's 10-year bonds like 14%, Turkey's like 30%. Okay, but what does that mean back in rands when you pick up the currency volatility? But the other opportunity offshore is actually buying South African government offshore debt exposure, hedging it back in
dollar-denominated debt,
yes.
Phil.
Yeah, and then when you hedge that back, you can often get extra 1 or 2% over some of the local opportunities. Now that wasn't available to us, Sid, Brand, and myself been in this market 25 odd years. You couldn't do that a long time ago. You weren't able to, you weren't allowed to, it was too expensive, all those other things, the opportunity set wasn't there. Where now those are very real and very easy for us to do. Instead of chasing
sorry to interrupt you, is that if historically South Africa hadn't borrowed extensively in dollars, are they borrowing more in dollars now than historically?
It's still very low proportionately to the local market. It's much more expensive as well. So when the South African government borrows relative to repo or JARBO in South Africa, it's very, very tight. As soon as you go to London, you're going to have to pay relative to the prevailing rate a lot more. It's the same with Standard Bank in South Africa. The banks get away with borrowing very low spreads relative to government, and sometimes even lower than government spreads in South Africa. But when Standard Bank or First Rand, whoever goes to London, they're sorry, you're going to have to pay 2% more for that. So that is something we can take advantage of. But it's definitely more expensive for them to borrow, relatively speaking, in foreign currency. And then if your Rand loses 10% quickly or 20%, your debt's gone up by 20%, your borrowing costs are gone up by 20%. So they would prefer to borrow in the local market, where effectively it's a cheaper way of borrowing and a safer way of them borrowing as well.
Phyllis, there's still enough demand locally, because we've seen the foreigners pulling out of our market quite a bit.
So there's two things here. The one is actually the foreigners, believe it or not, own a lot more of our debt than they did quite a few years ago. The problem is there's a lot more debt to hold. So the foreigners still own about R1 trillion worth of our local bonds, which is now, let's say, about 23% of those bonds. They used to own 43% of our bonds, but that was of a smaller pool. So they've actually still own a lot. But what's happened is where the foreigners as a proportion have moved out, based on downgrades to junk and index flows, etc., all of those things. We've seen that taken up to an extent, the asset managers, because I think asset managers in South Africa tend to be historically very equity focused, and we were talking multi-asset. So bonds were ignored, I think, relatively speaking, for a long time, but the banks have also taken on a lot more. But actually what we're starting to see is some of the ETF the emerging market ETF flows are starting to move back again away from dollar type assets, and we're starting to see South Africa starting to get some of those flows back again at the moment.
Yes.
Thanks, Paul.
Eugene, if I could just jump in there, I think just one point I want to mention is that I think while we're talking about foreign flows, and Phyllis is quite right, you're seeing that buying coming back again. But I think what has also happened is that there's been strategic buying by the offshore players. So whereas before they would just either buy or sell, they're now very strategic in where along the curve they actually buy. So they're willing to actually see along the curve whether they want to take on more or less term risk. So they're actually playing our curve a little bit more in a more sophisticated way in which they've done in the past. And I think that's good for us, because I think the more players you have in the market and the more type of strategies get involved in the market, it creates more efficiency in our market as well. So just in terms of the offshore players, they've become a lot more strategic in the way in which they've participated in our markets.
And Cindy, but that also creates more liquidity and more efficiency in our market. Am I correct in saying that?
Absolutely. I think that's the whole point, and that's what we want. There's sufficient demand from the local, or there's decent demand from our local players. Absolutely no doubt about it. There's the pension funds are there, and as Phil said, the ETFs are coming into play now as well. But most certainly we do need the foreigners, because not only from a hard, fast, and practical point of view, but also from a softer point of view, from a confidence point of view. Because once you get investment in the country, whether it's through bonds or any other format, it creates more confidence in the market. And that is what we need. We need that confidence to come back. So absolutely more efficiency, love that. But the confidence is what needs to come back.
So it's a function of more people say, more people, global investors see, there's appetite for South Africa, and then the others just follow them basically for the confidence, as you mentioned it.
Well, yes, I think yes and no. I think first of all, going back to the emerging market sort of argument, the common thread that we're seeing through the emerging market, whether it's Turkey or Brazil or Mexico, even though it's triple B, I think minus or whatever the case may be, with negative outlook, is that you've got high yields. The issue then becomes what kind of risk do I want to take? What kind of sovereign risk do I want to take? What kind of currency risk do I want to take? Am I going to get my money back at the end of the day? So if I'm sitting in London and I have to apportion my money across the globe, across emerging markets, I'm more concerned about risk than actually which country I'm investing in.
Okay, no, that makes well, you're raising your hand so nicely. Yeah.
I think it's quite important to understand those foreign investors as well. There's different types of foreign investors. There's sort of like shorter money, longer money, and banks and all sorts of people play. But we've got a lot of liquidity still in our local bond market, particularly relative to a lot of the others. And we've got a lot of demand. We can see it in the auctions every week where the government effectively comes out and borrows sort of 4.5 billion, 5 billion rand across the different bonds, and it's about 3 to 4 times oversubscribed, depending on that type of thing. But at the end of the day, a lot of those foreigners also separate the sort of bond exposure and the currency exposure as well. So a lot of those foreign players will buy, they'll come into the local auctions or they'll come into the market, they'll buy our South African bonds, they hold them. And at certain times, they will hedge out the currency risk, and at other times, they won't. So many of them operate quite differently to the way we've been talking, where they try and add value at a currency level and the others. So it's not impossible for them to be positive South African bonds short our currency or vice versa, and they take that on and off. So as much as the bonds and the currency do move together a little bit over time, because essentially you're taking a view on SA, they can change their mind on those two. So now's a good example is right now where the rand's been relatively strong as the dollar's weak. They are more positive on our currency, but they're also buying our bonds. And we've seen the bonds probably rally probably more than the currency has potentially. And you could see it go the other way again.
Thanks, Phil. Phil, you, Sydney, and Braden actually mentioned liquidity now in the last, every time you guys spoke. How important is liquidity? And I want to bring that back to specifically credit in South Africa as well, because most of the funds we're talking about here are multi-asset income funds or bond funds. So it's a very liquid, seen as a low risk type of investment. And how is investors supposed, or how are portfolio managers like yourself how do you manage that? How do you not get your portfolio in a whole bunch of positions, get potentially phenomenal yield, but it sits in completely illiquid type of credit?
Shall I tackle that one?
Yeah,
go for it, Sydney.
I can jump in.
Brandon, are you going to kick off?
Okay, give Brandon the thoughts.
Thank you, Sydney. Yeah, I think liquidity is a spectacularly important characteristic of an income fund. All of the assets that we introduce into our funds have individual liquidity scores, and we actually take pride in the fact that our funds can be completely liquidated within relatively short periods of time. In particular, one of the advantages of the offshore space is that we are such small participants in offshore sovereign and corporate debt that our ability to liquidate those positions is exceptionally quick. The danger that you were talking about specifically is trying to achieve kind of above market yields at the expense of liquidity. And then therefore, is it really an above market yield, or are you simply being compensated for a diminished level of liquidity? So that's the important aspect that I think we have to be honest with ourselves about.
But Brandon, I think that's exactly what I'm alluding to, because there's some income funds out there in South Africa where you get this phenomenal yield, but it comes at a cost. Now, fair enough, it could be liquidity, or it could be duration, or it could be credit, but it's specifically, this comes at a cost. It's not that you can all of a sudden have an income fund and you're sitting with a 2% higher return than all your peers. And liquidity is one of those risks. Phil?
Yes.
Yeah, I think, 20, 25 years ago, the only bonds you could really buy and trade were the sort of the government bonds. They're very liquid. They are market makers in these bonds. That was my job. It was a horrible job 25 years ago. And basically they are major banks that provide liquidity. That's their job to be there. So there's always a government bond is probably 1,000 times more liquid than any corporate bond or more in South Africa. It really is, because of it's sort of almost like a guaranteed liquidity. However, though, when you're investing in fixed income now, you've got credit risk is the one risk that is actually probably the most important thing you're thinking about. So when you lending money to a government, it's still credit risk. It's just not corporate credit risk. And that's like, can they pay me back? Can they give me my money back?
But at the end of the day, they can always print more money if they have to. I'm not saying that's what they do, but
yes. And liquidity gives you quite a good indication of the quality as well of that sort of debt, because there's more trade in it. Also, longer dated bonds, corporates don't get away with lending money for 20 years in South Africa. 3 years 5 years is a big line. Okay. If you can get away with a 20-year bond, the borrowers are prepared to lend for 20 years. Normally that's a good thing, and there tends to be a better liquidity. What's changed quite significantly, though, is nearly 20 years ago, you could get cash was 12. You could get an extra 1 or 2% from some bank type paper for doing that. You were getting nearly 14% from a cash plus return, but bond yields were only 7 or 8%. There was not a lot of issuance of bonds. Now it's the other way around. So the irony is the best credit quality, most liquid assets are actually giving you a higher yield, simply because we've got a steeper yield curve. So my point really is that the yields we're getting out of credit is very, very low relative to what we were getting 10, 15, 20 years ago. And you're not getting paid for that additional yield. And at the same time, what's happened is you're now getting, for taking on duration. So if duration is the risk that you're worried about, a little bit of capital volatility, the irony is if you take on duration, you're actually taking on more volatility, but you're taking better credit risk and better liquidity. And for the paradox of it all is you're getting better yield as well. And that's the opportunity in South Africa that's changed. And 20 years ago, you would have done things differently. 15 years ago, you would have done things differently. Now you need to have adapted your strategy to rather take on a bit more turbulence, but less credit risk and better liquidity.
At the end of the day, it's like Sydney also explained, the markets are dynamic, and you guys also need to adapt to as the market trends change it. So yeah, that makes complete sense. Sydney, you look like you want to add something around that?
Yes. 25 years ago, I was also there, and the market only had one corporate bond in it. So maybe we can run a quiz later and see who remembers that, what that bond was.
I'm going to ask you guys at the end, but now everyone's going to sit and Google it.
Yes.
I'll give a clue. It was related to a company that sells a beverage that's heavily consumed at rugby games. So
yes.
That was way too easy.
Yeah.
But yeah, I think the point is here, you're talking liquidity, you're talking credits, and you're actually talking risk at the end of the day. I've been telling all our clients that, listen, I don't manage money anymore. I don't manage money. I manage two things. I manage your expectation. What do you expect from me? And then the other thing I manage is a risk. So if I'm using fixed income instruments to do that, then I'm doing that. But getting back to the liquidity aspect, it's crucial. It's absolutely crucial. But it also differs, and here's where the expectation comes in the terms of mandate that you are managing. If I'm managing a segregated mandate with one client in it that tomorrow is going to tell me he wants all his money back, then I have to have a very liquid portfolio. But if I'm running a collective investment scheme with thousands of smaller retail clients in it, I can play around with the liquidity and fix certain sections of my portfolio to get the target or the benchmark that I'm trying to hit. The issue is, and Phil's absolutely right, the landscape has changed completely, and it's even changed in the last 5 years or so. Since COVID, I think it's changed a hell of a lot in terms of the credit market, because liquidity has shrunk in that market big time. However, we're all plagued by this issue as portfolio managers of, it's a thing called mark to market, because at the end of the month or at the end of the day, a line gets drawn and we get measured on the value of our portfolio or how well we've done. What is your performance? And your performance is related to the value of the instrument that's sitting, or the instruments that are sitting in your portfolios. Absolutely, if you got a lot of high yielding instruments in your portfolio, but with little liquidity, you're going to look good, but there's going to come a time where you're going to have to be able to account for that. And I think the way of actually addressing that, and most certainly what we do, is we heavily diversify. So we diversify across the entire spectrum. I can carry on for a long time, but let's move on.
Cindy, but I think I quickly want to touch on credit specifically, and it goes hand in hand with the liquidity. And I'm specifically referring to something like bridge taxi finance. I think everyone on the call is quite aware of that. African Bank. So these are the bloods that we know of, and that was quite visible, especially in the multi-asset income space. But just coming back to the liquidity and the credit, should you guys as portfolio managers just rather stay away from it completely, or should you follow your process like you just mentioned, Sydney, and over diversify basically and have exposure to a lot of small ones? So if it does happen, then it's not a big event in your portfolio. How do you approach this? Phil, you want to kick off?
Yeah, so I think our sort of approach to credit has always been too big and too important to fail. So, you know, when we move outside of government and sort of the major kind of risks, then and I'm talking South Africa specifically, when we move into corporates, we don't even really look outside the banks, sometimes the insurance companies. So, you know, I always say the banks are a bit like Toyotas. They're not particularly sexy, but they're very reliable, and there's a very good second-hand market for them. I think there are teams, but because we are not as stuck to trying to generate a positive monthly return or a positive return over 3 months, you know, we expect a little bit of capital volatility. We say to a lot of our investors, if you think 12 months and longer, then we're going to be able to give you a better yield, because I can get over 11% from a government bond today, but then I'm going to be getting, you know, 9% out of some corporate bond that is much more risky and got not good liquidity. So I think if you've said, listen, okay, I don't want modified duration on my portfolio of more than 2 years. In other words, I don't want much capital volatility. It's going to drive you into that credit space, and then you better be diversified. But it's also going to reduce your liquidity. The opportunity set, though, that's changed, though, is that we can actually now get corporate credit exposure super diversified from the offshore side, hedge it back into rands, take out that currency risk. So the game to go and buy corporate bonds, and they don't trade, the spreads don't change. We're not being forced into that anymore. That said, though, I think there's a lot of teams that is their speciality. They are credit teams, so that's where they're going to be looking. But I think you've got to skate to where the puck has gone to now, and that ship has sailed.
Brandon, anything to add to that?
Yeah, I would completely agree with you. I think the offshore space offers a particular opportunity, particularly in credit indices, highly liquid credit indices, you know, baskets of credit of 100 and more names. So you're getting a huge degree of diversification without having to replicate that diversification yourself. So yeah, I think completely agree. The onshore space, and of course, Africa in many respects, and South Africa as well, is becoming more of a private equity, private credit type arena, where mezzanine finance and other levels of credit are better suited for the growth ambitions of the companies that are borrowing money, as opposed to, you know, what we would prefer are the standard, you know, senior debt, sub debt, very little complication attached to it. I think in the credit space, simpler is always better.
Yeah.
Okay.
I'd like to, Eugene, just echo what Brandon is saying there. I think that simple is better, but it does not absolve us as fund managers of not doing your homework. So I think that's the important thing. Do your homework and then make the decision. You know, at Cadiz, we've got different levels of doing our homework and then jumping the hoops and then getting it through the credit committee. I think you've got to do all those good things. However, it is not always possible to pinpoint everything, because the structures have become quite complex, especially in the credit space, and to look through to the absolute detailed level becomes very difficult in determining exactly and precisely when this potential investment could default, or whatever the case may be.
Yeah, there's a massive legal aspect to it as well, like you say.
Absolutely, you need 5 law degrees to get through some of that paperwork, but it doesn't absolve us as fund managers from doing our homework.
Doing the work.
But absolutely, the diversification is important. I think the other thing that's very important is to realize that by selling your soul for yield, actually then just defeats the object of actually managing your funds in the first place. Yeah.
Paul, you wanted to add something?
Yeah, I think the lesson in South Africa as well, African Bank's probably a good one, where even though it was widely held and particularly by the very big asset managers, is when something went wrong, it didn't trade, nothing happened. It just delisted. And then you got divided up into good bank, bad bank. The irony, by the way, with that is at the end of the day, investors haven't actually lost any money because it all got paid back, but it's taken like a decade to sort of do that. The point, though, is that if you are going to look outside of your most liquid credit, better credit quality space, if something does go wrong, you cannot get out of it. It doesn't trade. It just freezes up. So it's not like, oh, I'm going to take a 50% capital loss and then I can sell it to someone else's. In our market, that's unlikely. Where the foreign credit markets, and this is where I think we've been spoilt in South Africa, is credit spreads move. You know, a lot of our income funds in South Africa that have been sold as cash plus or behaved like cash plus for the last 10, 15, 20 years. If those are foreign, the investors would have been shaken out of those things because they would have gone, there's capital, there's spreads moving all the time. So our market, because there's a wall of money, there's over 800 billion rands in income funds that are chasing credit. When you get to buy them, you hold them and you don't sell them. So even the good ones don't really trade that often. You can sell them if you want to, but most of the investors buy and hold them. Where in that global market, spreads move. And that's a good thing. Liquidity is a good thing. It means that you can get in and out. And that gives you a better, so in other words, bad credit quality, something goes wrong, no liquidity. Good credit quality, if something starts going wrong, you can buy and sell and things will move on a daily basis.
Guys, it's starting to run out of time, and there's one more question I have to ask you, and then we'll finish off with just a lot of quick questions. There's this constant noise around a lower inflation target in South Africa. Is this good? Is this bad? Should a developing country like South Africa have such a low inflation target? And at the end of the day, our inflation is actually determined by the oil price. So I would like to hear all of your opinions on how you see this, and will it actually happen? We're going to have to try and keep it relatively short. Phil, I can see you want to go first. You can.
So there's a couple of things. The Reserve Bank's job is not actually to manage inflation. The Reserve Bank's job is to manage monetary stability and the credibility of our money. So what does that mean? So inflation means that your money is getting worth less and less every year. Okay, so they need to manage the expectations around inflation as well. So one of the biggest things in our budget, which is around 800 billion rand at the moment, are government employee wages. Okay, if we can manage those expectations down to 2% for increases instead of 5%, that has an enormous impact and a virtuous, a positive impact on the economy. And also, if the expectations of everyone is that inflation is closer to 3%, then wages are lower, price increases are lower, etc. That has a positive, virtuous impact on everything from keeping lower inflation lower, positive views. Foreigners who see low inflation means that your currency is not depreciating, and that then pushes money back to us. So if we can get this right, that is probably one of the catalysts to get bond yields from 11.2 down to 9.2. So if we can pull it off and we can do it and we can get the expectations of investors right, then that's important. But as you said, there are certain things that we don't have control over.
Brandon?
If I can add to that, I completely agree. And that is, though, much more of a longer term perspective. In the short term, I think there are some very real concerns that a lower inflation target of, say, 3% versus the 4.5%, that would infer that the Reserve Bank will keep interest rates higher for longer to force it down. And I think that brings up some serious questions about the appropriateness of that strategy in a low growth, high unemployment, and I know Eugene had some questions about employment and unemployment, in a high unemployment environment. The last thing, if I may, just to add one more thing, I know we push for time, is a concept called fiscal dominance. And if you research it within the US, fiscal dominance right now has become a huge topic, a huge fear, because they're concerned that the regulator, the Fed, is going to prioritize the fiscus over its primary goals because it has a dual mandate of inflation and full employment. So I would also suggest that if the SARB is using inflation targeting to control fiscal expenditure via the government's employment, that doesn't bode well for the credibility of the SARB.
Okay. No, that makes sense. Thanks. Guys, we slightly out of time, so the next couple of questions, I just need one-word answers, no explanations. Thank you. Will Jerome Powell survive 2025, Sydney?
Yes, I think he will.
Phil?
Yes.
I hope so, and yes.
Yes.
Okay.
I hope so, and yes.
Okay. US interest rates at the end of the year, higher or lower? Sydney?
Lower.
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 Brandon?
Lower.
If you have to pick one developed market to invest in their bonds, which one will it be, Brandon?
US.
Phil?
US as well.
Sydney?
Got to be the US.
Okay. Favorite EM market outside of South Africa?
Sure. I would say Brazil or Mexico.
That's two answers.
Yeah, Brazil.
Okay.
Well,
I was gonna take Brazil, but yeah, not gonna touch Mexico. Yeah, rather Brazil.
Actually, none at the moment, to be honest.
no. Okay. It's still an answer. And then the South African currency, weaker or stronger by the end of the year?
That's a tough one, but I'm gonna say stronger.
Phil?
I think the bias is stronger, but depends on the dollar.
Yeah, I think the bias is stronger. Commodity prices are stronger, but very much dollar dependent, and of course, this whole tariff discussion dependent.
Okay. If it's stronger, though, do you think it can go below 17? Just yes or no?
Yes.
Can go below 16.
Mm-hmm.
Yeah.
Sure. Okay.
Yeah.
Yes.
I've got one question here. Again, we're going to try and keep it short from the audience. If you had to pick the part of the SA yield curve to invest in, which tenor would you buy? Brandon?
I'd buy the 2035s.
Which is, when do they mature?
Call it a 10-year risk.
10-year. Okay.
Yeah.
Phil?
About 20 years. So it's sort of just short of that 44
Further
area.
out. Okay. Sydney?
Medium to long end, but the long end is subjected to a bit of fiscal risk, so probably a bit more medium. 10-year.
Medium. Was that about 10 years or out to
10 year.
20? Say
10
again?
to 20, yeah. Yeah,
10 to
beyond
20.
20 is longer.
Yeah.
Okay. Thanks. Gents, we're out of time, but just as a summary, I think what really stood out for me today is I like your analogy of SA as the cleanest dirty shirt at this point in time. And we get bombarded with negative news in South Africa the whole time. The GNU is collapsing, our debt to GDP, our unemployment rate, which we didn't even touch on. There's all this chaos, but all countries have chaos. I like Brandon said, I love that South Africa is the Switzerland of Africa at the moment. Like there's massive, massive opportunities in this country, especially in the fixed income space. And I think that's something that came through in all of your feedback today. Yes, there's opportunities. Yes, you need to diversify, but there's more than enough and there's sufficient opportunities to get a proper yield at decent liquidity without taking on additional risk. But with that, I'd just like to say thank you very much for all three of you and your input today. I think we had a really robust discussion, and hopefully we can do it again soon. Over to you, Eugene.
Eugene, thank you very much. And every time somebody says Eugene, I get worried. But I answer now or not? Eugene, thank you for a very interesting conversation. And to your panel, Sydney, Brandon, Philip, it's been absolutely great. Maybe just one quick question from my side. We get it very often from intermediaries where clients are weighing up, going into a bank deposit fixed for 12 months or 5 years. Or should they go into a multi-asset fixed income fund? And I don't think it's a right or wrong answer, but maybe Phil, if you can give your opinion on that. Why would a client rather consider a multi-asset fixed income fund for the next 12 months or 3 years as opposed to a bank fixed deposit?
So, I mean, at the end of the day, we are shopping around for the best interest rates possible with, billions of rands. So we can get better rates than you would if you go to the bank. Secondly, you're not locked into a rate for a certain point in time. So, a few years ago, rates were 3.5. If you had locked in a 5-year fixed deposit, you would have been in trouble. We can lock in a 20-year rate, and make that part of the portfolio, and you're not fixed in. We can move out of that. So, we're running at a yield of just about 11% at the moment, and it's fully liquid. So you're not locked into any rate. And when interest rates change, and it changes, we'll change for you. So to go and lock yourself in at one rate at a lower rate than we can get really makes no sense. So really, we're trying to do that for them, and then manage it actively and find the best interest rates possible. As simple as that.
And I do think there's still a lot of money stuck in banks that we can go fetch and move to flexible fixed income funds. I think that's one of the biggest challenges of the industry as well, is banks and all the money being stuck in there. I mean, if you invested in one bank, you've got credit risk of one institution. But I will park it there. To our panel again this morning, thank you so much, Eugene. Thank you for making for great conversation from Optimum Investment Group. And now we also have a better insight as to what you do. So thank you for that. Just a quick reminder to our audience, next week, Wednesday, we've got Argon Asset Management and Granite Asset Management, the 6th of August. Can you believe we are done with July, moving closer to spring? But let's see what happens. To our audience out there, thank you so much for attending and your continued contribution. To our team this morning, thank you so much. And to the BCI team, thank you.